12th Annual Motilal Oswal Conference. Good morning, sir, and thanks so much, for joining in. Appreciate your time today. How has demand been for you? The retail loan book disbursement for HDFC Limited has been close to about 26%. Now, with the fact that monsoon has been pretty much normal, it's on track, have we seen an increase in demand for retail loans for HDFC Limited? How has demand panned out in the last few months and your expectation going ahead?
Yeah, so historically, we've never seen a slowdown in housing loans, in the demand for individual housing loans. Even at a point of time, a couple of two, 3 years ago, when the economic growth was much lower. So we have two parts to our business. One is the retail part, which is loans we give to individuals for buying houses, and the other is loans we give to non-individuals. Now, the individual component has continued to remain strong. We saw in the first quarter, and I don't want to talk of numbers which are not in public domain, but if you saw the first quarter of the financial year, which is April to June, we saw surprisingly a much higher growth than what we had seen in earlier quarters, and we saw the growth coming in at 26%. So hopefully over the next couple of years, we would expect to continue seeing a reasonably strong demand for individual housing loans. I think we have to understand the basics on why the demand is strong. The demand is strong on the back of the fact that penetration levels in India are extremely low. We have a fairly young population, and people generally buy a house only when they're in the mid-30s. And with 65% of the population being below 35 years of age, all these people will progressively, over the next 1, 5, 10, 15 years, need housing and therefore housing loans. So on a structural basis, my sense is demand for housing in India will always remain strong.
So the numbers, the growth rates that we saw in Q1, do you believe they're sustainable?
I don't know whether 26% growth is sustainable, to be honest with you. We've never targeted 26% growth in history. But if it continues well and good, we'd be very happy.
So what is your target? You're saying 26% was never targeted. What would be the comfortable range?
We have never given forward-making statements. The only statement we have made historically to our investors is that for over the next 3, 5, 7 years, we'd look at a 15 to 18% growth in our individual loan business. But now, historically, this is a statement we've been making for several years. Having said that, if you take the last 5 years, or for that matter, the last 10 years CAGR growth, it has been somewhere in the 20s.
All right. Hi, Mr. Mistry. So you're sounding quite positive with an outlook for the next few years. Your margins have been at around 3.8% or thereabouts. What's the trajectory going ahead? Do you believe you can hold on to these levels?
I would never look at margins that closely. I would look more at spreads, because margins get impacted by a whole host of issues which have nothing to do with the operating business. For example, it depends on the quantum of capital that you raise, the amount of debt-equity ratio that you carry in the balance sheet. So margin is inversely proportionate to return on equity. So what we really target is spreads. And if you look at the last several years again, and you will see this on our website, our spreads have ranged in a very narrow band of around 15 basis points, between 2.20% and 2.35%. And we see nothing today which would make us believe that spreads would not remain within this range. Whenever spreads go beyond a certain level, we always pass the benefit back to our customers by reducing lending rates. And again, when spreads fall below a certain level, we increase our lending rates. We've seen a fair amount of liquidity in the system. Incremental borrowing costs have clearly come down, no question of a doubt about that. However, for that to translate into a significant growth in the balance sheet to enable us to drop lending rates is something we keep evaluating on a continuous basis.
Okay. Sir, your second Masala bond is open today. Your first one was, of course, highly successful. A two-part question. A, how does it change your cost of funds structure, these Masala bonds? And secondly, would you be looking at this route more to raise funding?
See, we have, for us, money is raw material. Our disbursement needs are close to 10,000 crores a month. If you look at retail and non-retail, a little under 10,000 crores. So for us, this new Masala bond issue that we are doing of 500 crores is not going to make a material impact in terms of cost of funds. But the way the first Masala bond has traded, it has traded up significantly, which means the yield to the investor has come down quite a bit. The yield to a new investor would have come down quite a bit. My sense is when we close this issue and we would price this issue, there is a T+3 period which is there. Once that gets announced, I'm sure the pricing will be much lower than what the last pricing was. The last issue was done at 8.33% YTM, and this should clearly be done at a much lower yield.
Okay, Mr. Mistry, we've...
Now, sorry, your other question on...
On
sorry,
more,
one
yes.
more question you asked me.
Yes.
On the Masala bond. So, as I said, 10,000 crores is our monthly disbursement need. So we need to raise money from a variety of sources. Masala bonds has opened up. The markets have now opened up. We believe that the appetite for foreign investors to invest in India is huge, given the fact that India's economy today looks very strong, and given the fact that global interest rates are very low.
Okay. Your individual loans have been growing at a faster rate than corporate loans. Have we seen a pickup in corporate loans? Because the market is keenly awaiting when we will see a turn in the earnings growth for individual stocks. And one way to judge that would be the fact that if corporate loans are picking up. What's your sense on that?
Yeah. So before I answer your question on corporate loans, I think it's important to understand individual business also. Our individual business is sourced through a variety of channel partners. And to all these channel partners, we pay them a commission or a fee for getting business for us. We charge that entire commission to our P&L account upfront. We do not amortize that over the life of the loan. So when individual business grows at a faster pace, it has an implication in terms of accounting profits because the commission would have been charged to the P&L account upfront. Now, talking of corporate business, there are three categories of corporate business. One is corporate loans, which is loans given to companies for their own real estate requirement, their own offices, or for giving loans to their employees. The other is lease rental discounting loans, and the third is construction finance. As far as the construction finance portfolio is concerned, the demand has continued to remain strong. It frankly never slowed down. Construction loans today constitute 13% of our total book. And if you were to go back to, say, 2007, the number would have been more or less similar. Where there has been a slowdown is in the other two categories, which is corporate loans, which in 2007 would probably have been as much as even higher, would probably have been 13-14% of our book, and that number today is 9% of our book. And lease rental discounting, which at one time would have been 9 or 10%, and today it's 5%. So these are the two categories where there is a slowdown. Now, we have seen some traction. We have seen a lot of traction, if you ask me. How much of that gets dispersed in the next 1 quarter, 2 quarters, I honestly cannot answer. But having said that, if you look at the 4th quarter of the last financial year, January to March, we saw a very sharp pickup in that segment. So if I recall right, we had nearly 4,000 crores of disbursements that were made in that period. It's not 4,000 crores of disbursement, it was 4,000 crores growth in the loan book, which is substantial. So my sense is as economic activity picks up, and I have no doubt in my mind that that will happen, given the fact that, as you mentioned, monsoons have been good, number one. Number two, the macro looks superb. The macro in India has never looked as good as it does today. Current account deficit is under control. Fiscal deficit is low. RBI has built up reserves. Inflation has been fairly managed. Currency has been very stable. So macro India looks very, very strong. And that has to, in the very near future, translate into larger investments. And the monsoons would clearly facilitate that process.
All right, Mr. Mistry, thanks so much for